We were talking before about how you do see long-term value. Perhaps it's not going to be in 6 months, but 12 months, 18 months, all of a sudden you do start to see upside for both bonds and stocks. Is there a shift, though, that you're seeing or you're making in terms of what the post-pandemic, post-distortion, post-inflationary environment market looks like versus what we got used to over the past couple of decades?
Yeah, Lisa, I mean, if I had to sort of sum it up in one clean sentence, it's this idea that growth at any price investing is dead, or at least it's dead for as long as money's not free. And given where the Fed is going, given where we expect the Fed to land, and given where we expect the long-term trajectory of interest rates to take us, I don't think money's going to be free anytime soon. I think the Fed is desperate to avoid that. But on the flip side of this, Lisa, right, it's this idea that growth at a reasonable price investing is still very much an investment philosophy that is on the table. It is still a reasonable way to approach investing right now. And so ultimately, when I think about this sort of new normal post-COVID world of higher interest rates and challenged growth, we want to be looking for quality, and we want to be very active as investors right now. Index-based investing, I think, is just not going to cut it next year or even the year beyond that. Do
you think that index investing is dead, Jack?
No, I don't think it's dead, and I think when you look at what's gone on with multiples right now, given the fact that everything is on sale, as Peter mentioned earlier in his comments, I think there is a really nice beta tailwind that we will see in markets right now. But there is so much room for active outperformance with the right sector and security selection, frankly, with the right manager selection, that it makes sense to be an active manager right now in a way that it perhaps did not over the last few years.